The story for Asia is amazing for the next 5 years. It's actually the rest of Asian countries outside of China doing what China used to do for 20 years, and there's rapid development because all these countries want to become the next China. All these countries can see, wow, if we organize our institutions better, if we reduce corruption a bit, if we build the right infrastructure, and because of the cheap labor and young population, and the opportunity of factories moving away from China on the margin, we can actually do well. They can all see it. And the aspiration of people of Asia, that they want to have a better life as well, like anyone else. So it's a huge opportunity for investing when the valuation is cheap. I'm Dr. Joseph Lai. I'm the founder and also Chief Investment Officer of Ox Capital. We are focused on emerging market equities with a special expertise into Asia in particular. Its emerging markets are basically countries which are, in most cases, developing countries. And the bulk of it is actually Asian countries. In the next 5 or 10 years, I mean, this is one of the most interesting asset classes in terms of making money. In Asia, most Asian countries are just climbing up the ladder, you know. The second thing is the valuations. The valuation is very cheap. There's growth, and a lot of these countries, thirdly, can actually deal with inflation a bit better than developed markets. And in fact, during times of sort of more prolonged inflation, if you look at the history of markets, emerging markets generally can do better than developed markets, particularly those countries which actually produce commodities. So they benefit from the rising cost of energy. They benefit from the rising cost of minerals. I mean, Australia would do okay as a result of that as well, don't get me wrong. But when I look around, I can see countries like Indonesia, they benefit from the rise of commodity. I suspect we've got a good at least 5 years of strong, sort of high level of commodity prices because of underinvestment in the last 10 years. The world's still growing, emerging markets still growing. There's literally 5 billion people on this planet still developing economically, and they need all these commodities and energy. Another more nuanced story is this, is that China is going to grow slower. I mean, there's no doubt because the base is big, and also the easy growth is more or less over. Easy growth was simply that, factories, people opening up factories in parts of China, like in Guangdong, close to Shanghai, have lots of migrant workers from China move from the farms, rural areas, moving to the cities. I mean, in the peak, it's like literally 15 million rural workers moving to the cities of China every year to fill these factories. It's amazing, right? So during that period of rapid industrialization, rapid factory construction, outsourcing, it's amazing because people suddenly, the wages people first of all got jobs, and second of all, the wages kept going up, and that's easy growth. I think that period is over because first of all, a lot of the rural workers has been exhausted, and nowadays not everyone wants to be a factory worker anymore in China. And thirdly, there's geopolitics, which means that incrementally, the factories, at least incrementally, when they want to put new factories in, they may not want to put 100% in China. But China itself is actually climbing the technological ladder, and they're very focused on developing their own industries through the desire to develop and also through a fear of getting excluded by being the access to Western technology. So they're investing a lot there. They'll get there eventually, just take a bit of time. So it's interesting to look for companies which are climbing the ladder in China. And if you can find those are the champions of China for the next 5 or 10 years. It's like owning a champion company like Tencent. Tencent is a big Chinese company, right? Most people heard of it. WeChat, game. It's like buying a Tencent 15 years ago if you can find a champion technology company in China today. That's what we've spent the bulk of our effort doing. And don't get me wrong, we still like Tencent, but we also want to look for the other bits, which are more interesting. But the other side of it is that as there's more factories getting built outside of China, these countries which are doing that are just growing the same way that China did 15, 20 years ago. I remember going to Guangdong and Dongguan, factory workers lined up doing sewing shirts and stuff like that. And look, very bad pollution then, but in China. But it's just rapid industrialization. I mean, if you look at part of Asia today, that's happening, right? Like if you look at Vietnam, that's happening. I mean, each year, the number of people, migrant workers going to Hanoi and Ho Chi Minh City, I mean, it's not quite 500,000, but it's heaps of people going there, working in factories, a few $100 US wage per month, doing pretty much the same thing as what the people in Guangdong did. Population of Vietnam is like 100 million people, roughly. So they're going through this easy phase of development. And in Indonesia, they're doing the same as well. There's a bit of reshoring of factories back to Taiwan. India, interesting, exports picking up. Investing in China, I think, requires a lot of the appreciation of the nuances and the experience to appreciate, what is going on. Look, it's a huge country, and it's extremely difficult to fully interpret. But having invested in China for a long time, it's important to realize that there's multiple cycles at work. In recent years, there's been quote-unquote crackdowns on various industries. But the reality is there's been ongoing crackdowns in bursts in China ever since the opening up of China in 1979. Really, it's more a result of a rapidly growing economy, and when industries grow so fast, there tend to be some dysfunctionalities. The government, rightly or wrongly, believe, they can see this industry is not growing well, it's got some distortions or some it's not leading to a good outcome for the society or for the banking sector. So they would have this thing called crackdowns, and really it's actually reforms. These are reforms of the various sectors of the economy. But when the crackdown is over, the rules of engagement will be clearer, and it's clearer also to the industry participants what the regulators actually want to see. Because without clear rules of engagement, these entrepreneurs, they do whatever they need to do to win, which in some cases is actually not good for each other or for the society. With the slowdown in the Chinese economy and also the COVID lockdowns, unemployment for young people in China has gone up a lot. Because of that, it is quite a bit of pressure for the regulator to actually relax monetary policy and also relax the regulatory tightening. And so both of these are happening at the moment, and we're seeing sort of a recovery, quite a quick recovery actually, in the Chinese economy. And then another one is just simply Indonesia. We just thought that Indonesia was a fantastic idea as a country which actually have been under most people's radar for a long time. Commodity prices are helping them, and actually the country's gone through multiple years of reforms, economic reforms that will help them for the next 5 or 10 years, and we suspect it's probably one of the more prospective countries going forward. Indonesia is a very interesting market because it's just a huge population, young population who are aspirational. They're all getting access to the smartphone, so they know what good looks like what a good outcome looks like for them economically. With economic reform and also this mobile phone penetration, which naturally creates new industries, right? With mobile phones, smartphones bring with it new internet businesses. One of the companies we like is this company called MAPI. So it's basically a distributor partner for a lot of the global brands. It's listed in Jakarta, this stock. Indonesia has lots of consumers. They're young, they're aspirational, as we said, but distributing products in Indonesia is not that straightforward. There's probably red tape that may not be easy to maneuver for foreign companies. And also, Indonesia is an archipelago, lots of islands. It's hard to get the products to different places. So what MAPI does is that it partners with the foreign brands to bring the products into Indonesia. They partner with more than 150 brands globally, and the brands are that we know. Brands like Calvin Klein, Nike, Adidas. So for every piece of garment or shoes that these companies sell in Indonesia, we basically get a cut of it because we help them sell it. So this stock is set to do well. Earnings is likely to grow by probably 40% a year for the next 2 years because Indonesia is opening up post-COVID and the economy is doing well. And the stock is probably still around 20 times earnings, when we first added to it, it was about 15 times earnings. There are lots of these interesting, attractively valued stocks in emerging markets, which you just can't imagine to exist in developed markets. And MAPI is not, is actually the leader in the field. We're not talking about third-tier player. We like, China as well, because just the valuation has been very cheap. So there's one particular company which is we liked, and it's gone up quite a bit already. But it's called AK Medical. It's a leader in orthopedic implants. So your knee joints, your hip joints. It does the 3D printing of the joints as well, for the more bespoke sort of applications for the joint replacements. China had this crackdown on the hospital sector, because a lot of these industries, it can be quite opaque, and in years gone by there's a lot of distortions in the system. So salespeople, kickbacks, and not necessarily the best products get sold in the hospitals, and the products are more expensive than they need to be because there's an extra layer. So Chinese government they want to improve healthcare coverage for the people, so they clean up the system. And so the result is actually, it's likely that a lot of the foreign companies, which actually were the expensive ones, they are going to lose market share going forward. And it's actually companies like AK Medical are going to win market share. They're going to grow the market share from 20% to maybe 25, 30% quite quickly. The stock price, because of the negative sentiment towards Hong Kong or China, and also because of the crackdown on the healthcare sector, has gone from like $25 Hong Kong last year a share, to when we added to it, it was like $3.80. So now the stock, I think, is about $6.80 now. Like, it's gone up quite a bit. And it's companies like this with like long-term story, long-term growth dynamic, good company, very, very cheap valuation that we like. I think, the story in China is one of, self-improvement, as opposed to the easy, just buy whatever, consumption because it's going to grow. I just don't think that's going to be the play. It's going to be, it's better be something that's good. And if it's good, I guess, do well. And it's quite interesting. Still, today the valuations of a lot of these companies are still very cheap, despite the recent bounce in the markets. Early in the year, most people were still very positive on the semiconductor stocks in the world, because, I don't know, like, it's the world's changing, we're all using semiconductors to do everything, Internet of Things, AI. They were very negative. With the COVID stimulus and the working from home, a lot of the demand for semiconductors in the smartphones, in the PCs, even cloud computing has been brought forward. The stimulus money, a lot of people use the money to buy notebook computers and TVs and smartphones, right? But now we're on the other side of it. Working from home, yeah, we're still doing it, but it's less than before. Smartphone buying is less, and the cloud, yeah, demand is big because people are working from home, but it's sort of not growing as much as before. The number of PCs sold before COVID was about 250 million units a year globally. During COVID, because of all these dynamics, it went to about 340. So you tell me, is it going to stay there? But most people don't think like that. Most people, yep, that's a safe. So now we're seeing semiconductor stocks in the last few months selling off, and we've made a lot of money actually hedging the portfolio using that instrument. So Taiwan, we shorted quite extensively actually. Now we're probably time to think about reversing. We actually liked energy, end of last year. We were a little bit early, but then we liked it end of last year because we liked the idea of natural gas as a transitional fuel for carbon neutral. So that's a growth angle to it. The reality is, even if we go really follow the plan to carbon neutral by 2050, which I believe we should, to move away from coal, we need a transitional fuel, and natural gas, based on most experts' estimates, demand for that globally would still continue for the next almost 2 decades. So there's growth there. But most people didn't want to own these businesses because it's seen as negative ESG, right? And to us, I thought, well, if we can find a good company that's spending a lot of their effort to try to improve the ESG, spending a lot of the cash flow in renewables, and has a good natural gas portfolio, like why not? Think about the move to carbon neutral. We do need to use commodities. I mean, if we are to build these solar panels, we build EVs, power grid, like to replace fossil fuel, to electrify the world, we need certain commodities, right? To actually deprive these sectors of capital actually is counterproductive. The medium to longer term, inflation will likely be a more prominent feature of our economies. And the reason are multifold, but the main one is just we've underinvested as global industries on upstream resources. I mean, commodities, energy. So as a result, it requires a cycle, for the capital expenditure cycle to catch up. The second is just a bit of fragmentation in the world. I mean, in the last 30 years or longer, we've been used to the world globalizing more and more. And what I mean by that is simply that, we can buy products from whichever is the cheapest. If it's from, Malaysia, we go to Malaysia. If it's from then China, we go to China. And then that actually is not good for controlling inflation. It's inherently more inflationary. The world's slowing quite quickly, I think. And as it slows, we'll see prices weakening, labor market maybe start to be less tight. But at the end of it, what is the easiest policy option for the central bankers when we're talking about recession again? When the inflation is not such a big problem, it appears. Bearing in mind, we're still having underinvested in our upstream resource. We're still suffering from fragmentation of the world. And money printing comes again. So the inflation comes back up. So it's like a stop-go situation. I actually was a medical doctor before I went into this field of finance. And the story with that was actually quite interesting because, as I was going through medicine on the 5th year of my medical study, and it's a 6-year course at Sydney University, I realized that my calling was not in medicine. My calling was actually in finance. And how did I know that? Well, my brother, he's got this book, Principles of Capital Markets. And he said it's the most boring book that he can ever read. But I picked it up and I read it from cover to cover. And I thought, actually, this is very interesting. The theories and the understanding behind how things are priced. Why a house is priced a certain price, why are assets priced at certain prices, what's the role of the interest rate has to play to the determination of pricing. So I thought understanding that is way more interesting. I finished my medical degree, I worked in the hospital system for a few years as an intern and resident, and then after that decided to actually try something else, tried finance. I took a course to study business. I did an MBA, and upon graduation, it was a recession. It was hard to get a job. But lucky for me, I was able to secure one with Morgan Stanley as a research associate analyst in the healthcare team. So that's the linkage. So I was a doctor and studying business or finance, sort of enabled me to actually join the finance world with some healthcare linkage. And the opportunity at my old shop, which was Platinum Asset Management, came up, and I joined them when they started the Asia Fund around 2004. It was a great experience, working for very clever people, with real integrity. As the time progressed, I was given more and more responsibility, looking at the stocks in Asia. In 2014, I was managing the whole fund, which I think at the stage was close to 4 billion Australian dollars. And when I left my old firm, I was managing about 8 billion dollars Australian, roughly around there, across multiple products. Because I thought, there's actually better opportunity elsewhere, and that's when I started Ox Capital. So the outcome, if we do our job properly, the portfolio would own a bunch of good, strong, in many cases quality businesses that's got a growth dynamic that will grow for long term, and we buy them when they're cheap. Most good ideas are stupid to start with. When Steve Jobs came up with the iPhone, most people thought that he was stupid or thought that it was a silly idea. There's Ericsson, there's Nokia, what are you doing? But so, a lot of the good ideas would sound stupid. The culture of a firm that likes to be one step ahead of the market has to be one of open transparency, analytical honesty, psychological safety, and a firm that encourages independent thinking. An interest in investing is great because it opens one's eyes to many different things. It allows you to delve into many different industries and companies. A career in investing is very fulfilling if you're in the right organization and if you are naturally curious, you're an independent thinker. But it's important to take it seriously, do the work, understand your process, your philosophy, and do enough work so that you're happy that to take on the market, even when the market goes against you sometimes. The reality, after years of investing in this market is that investing is hard. To do it well consistently is hard. In a bull market where everything goes up, it can seem very easy. But it's rare. It's actually quite rare to see a market like the NASDAQ. You buy it, you close your eyes, and you get your 15% a year for almost 12 years, 13 years. In most cases, the market can be choppy, and it really tests your resilience and work. If it's an interesting career, lots of people want to do it, and lots of people want to do it well. I guess if there's any advice, just try to think about what you actually like doing, what you're actually good at. Work as hard as you can to be the best you can be at it. And sometimes there's sacrifices to be had. But to win, just like going to the Olympics, to win, it's not like, it requires a lot of hard work. The person is talented, he's training every day, he or she is training every day, and there's a lot of hard work. And at the end of all that, the person may still not succeed. But the reality is we only live once, so take your best shot.